Hello, good evening, and welcome to Marcellus's webinar. As you can see on the screen title, Navigating Uncertainty with Asset Allocation. I'm sure a lot of you will relate to the uncertainty given the events of the past few months. Markets have been whipsawed. We don't know whether we should buy the dips or sell the rallies. We've got all sorts of advice coming from all sorts of market experts. Some of them perhaps right, but it's our own journey. Uncertainty is in some ways the nature of the beast. It's the feature of the market. Investments or investing is inherently a probabilistic field. To that extent, dealing with uncertainty is par for the course. What are the tools that are available? As we ourselves at Marcellus have figured on the investing side, valuation is perhaps the best risk management tool. Risk is equal to uncertainty. If you can create a margin of safety to incorporate a whole range of outcomes, you manage risk better. But at the end investor level, what we have been talking about in the last few webinars is around asset allocation, which is nothing but diversifying across uncorrelated assets, which allows you to deal with this uncertainty better. Why we are doing this now, as many of you know, we do periodic portfolio reviews for our clients, and through those reviews, many of you have asked us to look at your investments beyond Marcellus. As many of you have tried to do it yourself, you've shared that there hasn't been a proper systematic approach to investments, which in turn can lead to this asset allocation. Especially the experience of investors who have done this in a systematic way has been much better in the last 6 months, as you were able to deal with uncertainty better. And those of you who haven't clearly have sort of expressed panic in situations like this. We have highlighted the importance of asset allocation in the past few webinars. Several of you have written to us seeking help on that. So we thought we might as well share our thoughts on this subject and see if we can be of help to you. Now, to do that, I have with me my colleague, Manish Hemnani. Manish is, so until now, he's one of the co-founders of Marcellus, and he's been the CEO of Marcellus since the beginning. The way we look at him is he's been our problem solver for many things. So he's been managing his own personal portfolio with this approach to asset allocation. So we thought, who better than him to solve the problems that most of us are facing here and now, which is to deal with the uncertainty in the markets. With that, I invite Manish to share his thoughts on this subject. Over to you, Manish.
Yeah, thank you. Thank you, Pramod, for the kind introduction and setting the tone for this conversation. Thank you, everyone, for joining us on this Thursday evening. So, yeah, we'll, as Pramod laid out, the subject that we'll sort of focus a bit on is how to essentially work with asset allocation to navigate uncertainty. Asset allocation is relevant at any point in time for all of us, but more so during these uncertain periods or volatilities or market event that go around us, because that can raise the questions that Pramod sort of raised. So I think it's much more relevant today, but it's always a structured way to approach investments. So we'll start. We'll start with the question on why does this uncertainty in the market worries us, right? And I think the answer is simple. Each of us, every individual of us, we get out of this investing journey. It's nothing different than any other journey that we would take. And the idea essentially is to get to the point, get to a destination. And the destination is essentially our future life and goals. So we save today, we invest today, with the hope that our investments grow in time, to essentially to the point that when we need the funds to fund our goals, education, retirement, aspirations, whatever it may be, right? We have enough to essentially fund for that, and that's the journey we all take. The journey is long. The journey can be bumpy, but nonetheless, it's nothing different than any other journey, right? But if we don't define what the destination is like, right? In other words, what are we investing for? right? Uh, and on the other hand, if we don't define it and put it on a map, right? And even if you put it on a map, it may have multiple ways to sort of get there. And so if define, put it on a map, and then if you don't select a route that we like to sort of go on through this journey with, which aligns with our temperament, our style, our comfort, right? We run the risk of arriving, maybe getting lost at worst, or arriving late to our destination, or at best, maybe we'll get there, but we won't enjoy the journey, right? So the idea essentially is if we knew where we want to go, like the way we do in Google Maps, we punch in where we want to go. We know how do we need to navigate where we are going, and we get some sense of the terrain as well. Are we going to go uphill, downhill? Is it a country road? Is it a highway, and so on? We enjoy the journey, but if we don't do it with our investments, again, the similar sort of outcomes happen where we then don't get there, or we just don't enjoy the ride, right? And if we don't have this level of clarity, and then we get stuff like the tariff war that's happening, or any other market events, right? Markets are also cyclical. We go through those up and downs. All of us do, right? Which compounds, which adds to the lack of clarity, and which probably is the one of the biggest sources of financial stress, because we don't know where we are going to go. We don't know what's happening around us impacts or affects our ability to get there. And this ambiguity essentially is what causes a lot of stress, and I believe that's probably the primary reason why this uncertainty worries not just countries and economies and businesses, but individuals like us as well. So that's something we'll unpick and see how we can approach this in a more backward sort of solving and informed way, right? Um, it's simple. It's a cliche, but it's actually as simple as that, right? If you fail to plan, that's like planning to fail. Right? We do need to plan what we are here for. We need to plan what are we investing for, so that the direction that we take, the approach that we take, is more aligned to us to get there, right? When we talk specific about goals, right? What goal planning do, and if you have done the professional financial planning before, you would be aware of this, right? The goal planning helps you translate your life goals, which is what you're investing for, into clear, measurable, and time-bound financial goals, right? So essentially, say if you want to retire, which I believe is one of the goals for all of us, right? If we say I want to retire at 60, that's some sort of a measure, right? We know a timeline. If you then retire, what do I expect from my investments to fund my retirement? What sort of income do I want to generate? That's more data to it, right? And then obviously we can add with inflation and so on. But we picked a life goal, and the moment we want to turn it into a financial goal, we need to essentially punch in some assumptions, and all of these are assumptions because nobody can say what inflation will play out, and how things will change in between. Uh, but it starts with planning. If we take a goal based approach to life goals, they starts converting into some numbers, some values, which become measurable, trackable, a bit more tangible, right? And if we can plan with that, it sort of gives us a clear direction. So what does planning do? It gives us direction. It tells us what are we investing for. It forces us to translate these into specifics. What it also does is it creates a measurable path, right? We don't know how am I placed to sort of retire when I want to do. But if you have a quantifiable value, we get some sense of measure. Am I 40% there? Am I 60% there? Or what do I need to change? And so on and so forth. So it also provides a measurement of progress. The third thing it does is it provides structure, right? So as we will cover in subsequent slides, right, we have different goals. Different goals have to be thought through in a different way. The investment orientation to achieve those goals, to invest for those goals, has to be also very specific, which we'll cover. But what the planning does is enables us to essentially get that structure in place. And what the structure does is it gives us ability to maximize the certainty of achieving those goals. So we live in a probabilistic world. How things will pan out, nobody knows. But it takes us closer to the probability where we know to a certain extent, are we going to get there? And obviously, we have to pair it up with some sort of uncertainty or the unknown risk, right? When you talk about, so that does help us with the structure rather than blindly saying I have this and I want to just grow it, right? And in that process, we might taking up calls which are not aligned or not needed, right? Again, we'll unpick this more, but it helps us with structure. And most importantly, it gives us comfort because you planned, you know where you are, you know where you want to go. you have some sense of how to get there, you have picked up a path, right? It helps you sleep easy because now the journey probably is aligned to the sort of journey you'd want to take, right? If you like driving on the countryside with more greens around, maybe, that's what you're getting and driving with it. Right? If you like freeways, highways, then, you sort of take that. But essentially, this also gives you comfort because you have picked a journey that you are going to follow. It helps you sleep easy because you will plan for emergencies, contingencies, right? And we'll cover more of this down the line, but it helps you sleep easy. It helps you enjoy journey. It also helps you stay the course. Whatever happenings around me in the short term, today, tomorrow, on the noise that's all around us, does it really impact me? Should I really worry about it, or has my plan accommodated for it? Right. So it helps you stay the course, and avoids you from reacting to everything that's happening around you, which is predominantly driven by emotions, right? Because we are prone to so much noise all around us. There's greed, there is fear, and there's uncertainty, and there's everything in between. And what do I do? Should I do this? Should I not? Should I act? Should I not? Right? It avoids us from doing all of that because then we have some sense of whether this event that has happened, or this policy decision that has come out, how much does it impact me? So those are the few outcomes of goal planning. Obviously, it's much more than that, but those are the key dimensions of how goal planning helps us to get a bit of structure and direction on our journey towards achieving these financial goals. Right. Yeah, moving on. So again, each of us have multiple goals, right? If you just start thinking of it like that, right? Emergency funds, having enough money in the bank to deal with any planned risk, unplanned exigency, that's actually the primary goal. It would be goal for everybody else as well. So that's the first thing we all want to put. Buying a house will be a goal for a lot of us, right? The house that you live in is not an investment; it's a need. Right? At some point, you would want that. So that can be goal for a lot of us. Educating our children, is it a global education, Indian education, whatever it means, is an expensive affair. So that will be one of the goals for a lot of parents, for a lot of folks around here. Right? Retirement would be goal for all of us. At some point, we want to stop actively working for money and then pursue personal interests, which may or may not mean any paycheck at the end, but it's not the obligation for the paycheck. Some of us would want to retire early. Some of us want to know how soon can we retire, but retirement will be one of the goals. Retirement from the active occupation will be one of the goals for a lot of us. Then again, the bucket list, travel, experiences. This is all we had saved for early years in our lives, so that we can have comfort of fulfilling the experiences that we plan for. That's another goal. Again, this all again can be quantified, if you can be specific about it, right? And gifts and legacies, right? So we do want to either leave some gifts while we are around or after us in whatever shape and form. That's another usual goal that we see. And there is many more to it, right? These days, once your child has studied, maybe you want to help them with a startup fund, right? So they can experiment with money, do their own venture, or whatever they want to do with it, right? Just to get them started, sort of a launch pad of sorts. Marriage is another goal, can be goal. So that there can be lots that can be here, right? But we all do have goals, and when we think of wealth creation, we are doing it essentially to fund these goals at some point in time, right? And we should plan for each of those goals so that we don't get missed out on anything. So that's the central point on this one. And the second bit is every goal. As we say, every goal must be planned for. It also needs to be planned for from an investment perspective with a different orientation, right? So return maximization may not always be the objective, right? Probably shouldn't always be the objective. Different goals, different reasons. Emergency funds, for example, you are not expecting it to compound at a 14-15% rate of return. An emergency fund, the core need is liquidity, accessibility, availability at a moment's notice. You don't expect it to grow at any shape or form. You want protection and liquidity 100% on the table for the first one, right? Short-term goals, which are just around the corner, maybe a couple of years hence, again, they need to be guarded for the short-term more carefully. I mean, classic. I mean, we are setting in one of these things, right? If you have a short-term goal and the investments are not aligned, structured to fulfill from that, you might end up drawing down your investments, at a loss, which is not a great place to be again. So anything that is short-term, we have to ensure that whatever we have budgeted for, planned for, invested for, needs to be guarded for short-term market risk. right? And the long-term goals, obviously, it's long-term. We have more leeway. We have more time for cycles to play out, events to normalize, and things it does to me. Long-term has to be optimized for long-term wealth creation because time is by our side, right? But if we put compounding to work, the longer runway you have, the bigger the power of compounding. And here, again, we need to be mindful. These have to be oriented in a different way. So we look into it more in a bit, but these have to be thought through differently than a short-term goal or emergency fund. So that's again important. Different goals. Every goal must be planned for, but again, it needs to be planned for in the right way with the right orientation in mind. And risk is as much part of this as the return that we expect. Again, we'll pick up this in the next section, right? So here's the alignment piece, right? So your investments that you will make today needs to align with your goals, needs, and risk tolerance. So this is a standard framework of asset allocation when we talk about. Right. First thing is time horizon of goals. As we saw on the previous slide, a short-term goal needs to be thought through differently, invested differently compared to a long-term goal. Right. The second dimension is when you are planning your investments, which is addressing to these goals, required rate of return, right? So you pretty much know the size of investment you have, right? The size of the balance sheet, your net worth today, right? And because now that you would have translated your life goals into financial goals, you can pretty much see what is the outcome of that. What are the size of the fund that you're going to need at varying points in time, and what will be the value with assuming all the inflations and everything in place, right? You can compute what sort of rate of return do you need, right? So defining an endpoint and a starting point, which you already know, right, can get us to the information which will tell us, are you good with 8% or you need 18%? If it's 18%, is it achievable, sustainable, or some goals need to change? Or if it's 8%, do you really need to go aggressive? So on and so forth. More than anything, it informs you how to think about investing and, don't take disproportionate risk or do take informed risk where it needs to be taken. More important than not, it informs you of how to think of structuring your investments. And the third thing is the risk tolerance. This again goes back to what makes you sleep easy. This is the pillow under the head. You don't want to be in a journey which you don't enjoy. Right? If you like a smooth ride, getting on a bumpy road, you can only take it for so long before it starts getting into you. On the other hand, if you're okay with a bumpy ride and you can see, the roads open, you might want to fast forward a bit. Again, all within tolerance of not jeopardizing any of the of your goals. But again, the key here essentially is to live with comfort, sleep with comfort, and enjoy the ride. Because it's going to be a long ride, 30, 40, 50 years. It's a long time. So essentially, these are the key three dimensions when we talk about structuring the allocation and essentially structuring the objectives and working towards what's the optimal way to sort of build. So optimal comes from essentially these three parameters. Right. And while we are still at goals, every individual will have its unique set of goals and thus need, asset allocation investments tailored to their unique needs, right? So I've just mentioned a couple of points here, and we can say, assume Akshay, Mr. Akshay, he's living on a rented house right now, but is planning to buy a house in the next 2 years. How would their asset allocation look like, right? How much equity, debt, if we just keep it simple like that, should they be in debt or equity more? Right, but certainly it's going to be very different from Mr. Ashwini, who is living in her own. Ms. Ashwini is living in her own house, but their goal essentially is she's investing it for a retirement, which is 15 years hence. Right, so probably they are the same age, and I haven't added much of details to it, but even at a simplistic level, you can see the portfolio, even without doing much of a maths or a science or art behind it, has to be structured differently. Some buying house in the next 2 years, if that's what needs to be done, certainly needs to be protected from market volatility. Whereas retirement, which is 15 years away, certainly has to benefit from the market swings that will come on the way, because it's always going to be the case, right? So even with this couple of data points, you can see the allocation, the way they have to structure their investments is going to be different, especially if you add more to it, such as the ability to tolerate risk, market risk. Right? How much was the size of their existing balance sheet? What are the other goals that sort of come through? This just gets very, very complicated and very, very bespoke, right? So the central point is, even when we talk about goals, or some two people having same set of goals, for example, they may have other things which are very different. And hence this has to be planned, structured, thought through, and implemented for every individual, because every individual is unique, every family is unique, the circumstances, goal sets, all these combinations are unique. So that's the central point here. It needs to be tailored to you, specifically to you, and what works for you will not work for me. It will be suboptimal for me, right? So that's the point. It needs to be planned, but it needs to be planned for every individual family, right? That brings us to asset allocation, right? So what is asset allocation? Essentially, it's nothing but an informed investment approach. It's a way of planning your investments with the idea of balancing risk and returns, but with the core objective of maximizing the certainty of achieving financial goals, right? The central point is we want to maximize the certainty of achieving financial goals, or you can say probability of achieving certain financial goals. But the idea essentially is we worked hard enough to save. We want to be smart enough to invest so that when we need funds to pay for the education, pay for the house, pay for the wedding, or whatever goals we have, the money is there. The funds are there in the right shape and form, right? And asset allocation is an approach which considers everything that we discussed in the last couple of minutes into account, and then comes up with an optimal structure of how should I balance the risk, which means not having the outcome that I want, and the returns, which is the compounding that has to come in play to enable us to do that. And then I've just pointed out here, based on time horizon of goals, investment risk tolerance, and the required rate of returns. But the pie chart essentially is how an asset allocation look like. It's an indicative, it's not accurate, but it has to be made up of various asset classes. You have Indian equities in this chart. You have an element of debt. You have an element of income. You have gold and global equities. Indian equities is developed market, the country, the developing country, strong, strong tailwinds with us. So we expect high returns, but comes with sort of high risk as well. Debt gives us stability, the cushioning. Income gives us stability in terms of returns. Gold, uncorrelated to Indian equities, and equities in general, you can say even inversely correlated. When equities do well, gold doesn't do so well. But it's a known hedge. It's a very popular hedge, age old safe haven. Right, so clearly something that should be part of the portfolio. And then we have global equities, and as you would have heard in the previous webinars as well, remaining equities, it's a different market altogether. There used to be the degree of correlation between Indian markets and global markets, but that has not been the case, at least for the last decade or so, and they are decoupled and decoupled really well. So in extreme events, all markets will go one way, but usually Indian equities will have its own journey, own trend, and US or developed markets which will have their own journey. So multiple asset classes, how can you put them together to get the best possible investment returns, controlling for the risks, which then helps you achieve your financial goals? That's the central point. And asset allocation is the framework which helps you structure this. Right? Why does it matter? Right? Why go with all of this? Right? Planning is okay, but then why not just go with one stock, or with asset class? Why worry about multiples? Right? So the clear indication is asset allocation is the biggest driver of your overall investment returns. When you look at everything that you invested in, be it a PPF which generates income, or mutual funds, or equities, is the allocation that you have made across these asset classes, right? That drives most of your returns. There's a study, a very famous paper by Gary P. Brinson, said Determinants of Portfolio Performance, where they in the Western world, they analyzed 91 hedge funds over a long period of time, and they looked at what is it that drives most of the variation in the investment returns, and it was asset allocation by far, explaining up to 90% of variation. The stock selection, timing the market, what fund to buy, which stock to buy. There was some value add, 4%, 2%, so on and so forth, but nothing comes close remotely, by far, the asset allocation. So it's not what you buy, but what asset class you buy, how do you allocate your assets. That is what drives the overall investment return, is what we learn from this, right? And the next thing, again, these days you see this quilt everywhere, right? Because for the right reasons, right? So one thing we see in this chart, and I explained that table before, and then I'll go to the commentary. So table, essentially, the chart, the quilt, multicolored quilt is, you have a column is for every calendar year, right? So we looked in April to December, every calendar year. And these are INR returns in the boxes. The different colors are the different asset classes. So blue is Nifty 500 total returns. Orange is debt. Green is S&P 500, which is proxy for developed market equities. Gold is obviously gold. and then we have cash, which is gray, right? And for every column, you will see each of these colors stacked in a certain order, and it's a descending order of the returns generated by this asset class in a given year, right? So, for example, Nifty was a top performer, 39% in calendar year 14, all the way to gold, which did a -8% in terms of performance in that calendar year, right? And if you just step back and look at what you see colors everywhere, right? Nifty starts with Nifty at the top, then that suddenly, which we assume to be, we say suddenly tops at 9%. Next year you have S&P 500 and Nifty is back, and then you have gold. All right. So there's no pattern in terms of consistency of any single color being right at the top or at a certain position for all that matters all the time. Another thing you'll see, look at gold, right? Bottom of the table, then goes to the top of the table, then comes at the bottom of the table, then goes to the top. So the colors keep jumping all around. Central point being there's no single asset class which consistently performs across times, across market cycles, across market conditions, right? They keep shifting, they keep rotating, and nobody can predict which asset class is going to perform next. Some of them can do, they can get lucky, but on a sustainable basis, it's impossible to do it. And hence, but at the same time, you do want to own what has really done in the well, so that the compounding in your overall investment portfolio continues to perform. Right. So you do want to own the best asset class. And the answer is diversification. You don't know anything. You know no asset class will consistently perform. You can't predict which will do what. You do want to hold some. So the best idea is to hold some of each of these, so that at any point in time, a part of a portfolio is doing really well. Right. Another thing to bear in mind is each of these classes have their cycles, right? The reason the colors are shifting, there is some pattern in those shifts. Every asset class will have its cycle. The cycle over long term does play out, right? If you have something which is on the other side of the cycle, so while an equity is underperforming and gold is performing, the down cycle and up cycle will eventually revert. In the long term, if you see, all the cycles would have played out, and you will expect the CAGR number for every asset class is what we achieve. So on a long-term basis, the diversification sums up, plays out and crosses over the underperformance for various classes. The central point is we need to be present in all or most of these with a certain weightage, right? So that's the idea. And what we've done here essentially is we've created an example portfolio, again, picking up those asset classes. It's a dense chart, so I'll take a minute to explain how to read this. Right. So there are two lines at the top, an orange line and a blue line. So the orange line is a multi-asset portfolio, which is made up of income, gold, Indian equities, and global equities. And in equities are further broken down into small caps, small and mid caps, large caps, and we also have quality and value as a style. Right. So the table here on the screen gives you weights. We have 25% income in this portfolio, 50 odd percent of equities. There's 10% allocation to gold, and 13% allocation to global S&P 500. And what we've done is we on this weight, we have created a portfolio, and we rebalance it every month, right? So every month, some of these securities will outperform or underperform. We bring them back into the shape, right? And that's the sort of portfolio. That's the journey this orange line has. And what the green line essentially is Nifty 500 TSR, so wider equity market, and it's a total shareholder return, hence includes dividends and everything. Right? But what the chart is showing you is the drawdowns, peak drawdown. So what is the drawdown from the recent peak that we are observing, and we have plotted that. Right? And what you'll see is when the drawdown happens, generally speaking, you see the blue line, which is equities only. 500, it's fairly diversified equities, right? It records 500 stocks. But it drops much steeper compared to the orange line, which is example multi-asset portfolio drawdown, right? So, for example, when you look at demonetization, there's an 18% drawdown that happened in 16. During demon, the Nifty 500 TSR fell by 18%, right? Compared to 10% fall in a multi-asset portfolio. The reason for that is Indian equities was only a proportion of the portfolio in that period, right? So while the Nifty took a hit, while the equities took a hit, the performance was supported by other asset classes which didn't get adversely impacted because of demonetization, right? And if you keep going, right, ILFS crisis, again, the same story, equities took a beating, in a higher proportion, higher drawdown compared to multi-asset. COVID, when it came, you can see a steep drop in equities. Multi-asset stuck well. It actually recovered very fast as well. You can see, the gap between the lines when they go up. Right, part of it because of gold. Gold essentially took the journey the other way around, and there was some allocation of gold into this. Right, in 23 we had US started hiking rates, and we saw an exodus, and but multi-asset again stood well. And even in the very recent ongoing correction, which we are still sort of getting into, we saw a drop. Equities obviously fell much sharper, but multi-asset portfolio had held reasonably. It also fell down because it does have equities in it, but it didn't fall as much as equities only, right? So what we are seeing essentially here is the drawdown risk on a diversified multi-asset portfolio is substantially lower when we talk about market events and when the drawdown sort of plays out. Interestingly, the bar chart that you see at the bottom, right? That's for the same period we have done a performance CAGR. So what is the compounding in terms of performance that has happened in these two? And what you see is they are pretty much neck to neck. Nifty 500 doing 13.56 compared to a multi-asset portfolio 13.38, right? So if you put the two together, you with a diversified multi-asset portfolio, you see a substantially lower drawdown risk, right? But that doesn't compromise return. You still, over a long term, you achieved pretty much comparable results with both the portfolios. So when you adjust for risk, which is risk adjusted return, what returns are you getting for taking the quantum of risk? A multi-asset sort of a construct, does much better on the risk adjusted return basis. Right, so that's the central point of this, and this is based on the actual data. But it's an example portfolio. We have used certain assumptions to create that portfolio, and that's what you're sort of seeing here. Yeah, so that's looking back how sort of this would look, and again the question comes, right? So Nifty obviously, which is equity markets, will do really do it in the long term because they do deliver higher returns, but also the high risk. However, if you look at long history from Gen 95 until recent, and again, this is Nifty 500, there are extended periods when Nifties haven't added any alpha. So we're calling out here between Gen 95 and Gen 2003, a good 8-year long period, zero performance, no change in Nifty in these 8 years. Right, moving forward from December 7 to Feb 14, again, a good long 7-year period. 6-7 year period, no change in any. So had you invested in Nifty at any point in this time for 8 years, you would have gotten zero results, which if you adjust for inflation is actually you lost value on your investments, right? And same here. So there are periods where Nifties don't perform and which can last multi years, right? When you compare how do a multi-asset do in this period, multi-asset continues to perform, right? Again, what we have done is we have zoomed into this period. Sorry, zoomed into this period of December 7 to 14. You open it up, and the dotted line, the blue dotted line is Nifty, which you see starts from 100, ends up at 97, 97.3. But when you look at the solid orange line, that's the multi-asset portfolio, and it does relatively well because again there are other asset classes which are driving the performance of this multi-asset portfolio, right? So again, even in the times when Nifty doesn't do anything, multi-asset does bring in, does put other asset classes at play and generate some returns for us, right? So that's the case for multi-asset. Why do you need to diversify? Single asset class puts you in a, it's like putting eggs in the same basket. I mean, cliche, but again, very well understood and very meaningful. Putting all eggs in one basket or an investment in a single asset class can put you on a time risk, can put you on a long phase where you lose money because of the inflation eroding the value, but the returns not coming up. Right. So the diversification is important. We don't know what will work, but something will work, and hence we essentially be smart and diversify everything that we have across various baskets and not just one baskets. And we essentially mitigate the risk of all eggs in one basket. Right. So that's the multi-asset. That's the reason or the case for why and how a multi-asset portfolio performs. And at the back of it, we bring to you, we introduce the Marcellus multi-assets portfolio. We call it MAP internally, but essentially it's a multi-asset portfolio, which, as you can see on screen, it's invests across various asset classes. So it invests in low risk debt. There is an element of income. Debt brings cushioning. Income brings some stability in terms of cash flow returns. It obviously invests in equities. Equities will drive most of the returns of this overall portfolio, but it will also contribute to the risk in the portfolio. And then we have gold, which, as we discussed, is largely uncorrelated, but also inversely correlated, and hence it sort of works out as a relatively hedge to equities in general, right? So that's the asset class diversification. We further diversify into geography. So when we talk about equities diversified in Indian equities and global equities. Again, you got from Saurabh and my previous colleagues in previous webinars. Equity markets, global markets are just as much equity markets, and they have continued to show the growth along with the element of risk that comes with the equities, but very 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 distinct, very uncorrelated, and hence a diversification on this uncorrelated geography does deserve some allocation. And then because equities in India is going to be the largest allocation, because we know the country, we are living here, most of our income is coming from the country, most of our consumption is happening here, most of our expenses are happening here. All right, given the chunky proportion it will have, it's prudent to further diversify within two cap sizes, large caps and small and mid caps, and value and quality. Why do we do this? We've seen even within equity, large cap has its own sort of cycle, which runs different from small and mid caps. And again, quality and value obviously are the two distinct ways of styles of investing, and hence the diversification within the two also helps us to get a bit of both. Whenever quality is up, we'll get the kicker from the quality, while value will be there when the time turns. So again, larger point being, Indian equities also further diversified into large caps, mid and small caps, value and quality. And what it does essentially is break down the overall investment into these smaller buckets, which again, I'll repeat, over long term, all these cycles play out and you do get the returns that you need, but it reduces the drawdown, as we saw in the previous charts, right? So that's the Marcellus's multi-asset portfolio, right? Some key characteristics. So what do? We invest here within multi-asset portfolio, which is a PMS, again, similar to our other schemes, minimum 50 lakhs. But here the investments are made in direct mutual funds, ETFs, and market securities, right? So what we do, we open a demat account for you the way we do in equities, but we buy mutual funds in a direct format and a demat format. So we buy direct because they are cheap, and I think we're also by regulator, you've been instructed to buy direct only, but that's the cheapest way to get exposure to the asset class. And we buy it in a demat format because that it becomes easier to manage within the PMS construct. We buy ETFs, which are demat, and we buy market securities, which can be REITs, InvITs, and so on. So we invest in the underlying asset classes, which in the instruments, which are then essentially investing into these underlying asset classes, and that's how we create a multi-asset portfolio within the PMS construct. There's no conflict of interest. No Marcellus products is part of this portfolio. All right, all the investments we do are mutual funds available in the market. None of them we don't do mutual funds anyway, but none of our funds, none of our stocks, none of our PMS strategies are part of this. So there's no conflict of interest of asset allocation and multi-asset portfolio with anything else we do within Marcellus. Right, we have three flavors, three variants of allocations for three different risk profiles. So we call it aggressive, balanced, and conservative. Where the asset classes are largely the same, but we may have a different way to each of the asset class to control the risk return that's required for the respective risk profile. So three variants are available, and we also have an income portfolio, which is an SWP, a drawdown portfolio for generating a monthly income in the retirement or in the drawdown phase. So different portfolios, but within the same construct. This is actively managed PMS. It's not just that we buy and we leave. It's actively managed by the portfolio manager. There's a process behind how we select mutual funds. We focus on sustained performance, and we focus on on the price, right? We don't want to pay more for the same set of stocks that we'll get from a different fund if we were to buy that. Within that, again, there is focus on not concentrating on a single AMC or a single style. So there's an element of active and there's an element of passive. And when there is substantial allocation, we have multiple AMCs that we sort of invest in. Again, we are de-risking a concentration risk on an AMC per se. And so again, a lot of thought goes in. This all actively managed like another PMS. We do systematical and tactical rebalancing. So we rebalance the portfolios on a regular basis as and when needed. The rebalancing requires because some part of your portfolio, some assets in your portfolio will grow much faster compared to the other pieces, the other assets in your portfolio. And you need to bring it in shape. Otherwise, the equities eventually will become, at some point a much larger proportion, which will, move away from the allocation that you need. So the rebalancing has to be done actively. It needs to be done opportunistically so that the cost of there's a trade-off, right? When you rebalance, you incur a bit of a cost. But there has to be enough benefit to justify that cost. So the back of it, the manager essentially does all these computations, and we only rebalance when there is a value in rebalancing. So that takes effort and active monitoring of this. And the last thing, which is pretty important, especially in this asset allocation construct, is periodic reviews, right? So the asset allocation I'll show you for myself today, or if you get it done for yourself today, is real today. It's based on the information today, your life situations, your balance sheet, your finances, your circumstances, which are live today. Basis that we are projecting or building a path, right? But a year hence down the line, as your situations change, you will need to review your overall asset allocation. Some goals would have moved forward, some new goals would have popped in, some goals would have moved out, the value of the goals might have fluctuated, something else might happen maybe your finances would have shifted a bit. So this periodic review is really important to course correct and essentially ensure the allocation remains relevant for you at the right time. This is something we do diligently. We do it for all of the portfolios as well, but for multi-asset portfolio, which is backed by asset allocation, it becomes really important, right? And this is done by our investment counselors. So they are around. They do these reviews. Again, we do look at the whole information that you provide. We understand from you what has changed, and we course correct if needed. And there's constant support. Any point you need, have any questions, you always be open. We have hotlines open. You can reach out to us. We aim to answer questions within 4 hours. If you need more time, we'll let you know. But we'll work with you to essentially to help you manage this portfolio and support in anything you need from our end. So that's essentially the key points to call out within our multi-asset portfolio offering. So when we talk about asset allocation, this just brings the asset allocation in a bit more vivid colors. You can see, right? So this is a balanced allocation, which is in between conservative and aggressive. And what does it look like, right? So this is a standard allocation, a 25% allocation into debt and income. We combine the debt and income because it's cushioning as well as some cash flow generated at a constant rate from this pot. Right, so 25% allocation to debt and income within balanced portfolio. 10% allocation to gold, 13% allocation to global equities, and 52%, just about more than half of allocation to Indian equities. So equities put in total is around 65%, of which 13% is in global, 52% in Indian equities. And then because that's a bigger slice, almost half the cake, right, we further break it down into large and mid caps. 20% goes into large and mid caps, 12% goes into small caps. We buy mutual funds worth of 10% of the allocation for values, and then we buy another 10% in the growth. Right, so that's how we essentially cut down the full 100% slice into 7 slices, 3 at the top, 4 at the bottom. Diversification, and then we essentially buy mutual funds, securities, ETFs, REITs, InvITs, whatever is best way to get exposure to these asset classes in this allocation, and that sort of becomes your portfolio, which you can see here, right? So this is essentially how an asset allocation turns into a multi-asset portfolio by Marcellus. Right, so we look at the allocation at the left, and then on the right hand side, we break it down and create the portfolio for you. And the way we buy equities in an equity portfolio, we buy direct mutual funds and ETFs in a demat format in your multi-asset portfolio. So it's no different from an execution perspective. We actively manage this. We manage the administration, all the trading. It's a discretionary portfolio, so we do everything that needs to be done to run the portfolio. We do the rebalancing as and when needed. Again, if the benefit justifies the cost. And as we review with you, if needs any changing, we sit with you, we rework the numbers, and if the allocation changes, we realign the uh, allocation and essentially change the portfolio as needed. Right. So that's essentially how the portfolio or the allocation rather turns into multi-asset PMS. Right. And one thing I thought I'll spend a bit more time is the systematic rebalancing. Right. It's a key feature of a Marcellus MAP. And actually, it should be key feature of any investment that you do if you are taking an asset allocation approach, whether you are doing it by yourself or an advisor is doing it on your behalf. Uh, uh, is something that needs to be done, and that there's value in it. So what rebalancing does is essentially, as your portfolio part of the portfolios overshoot or undershoot based on mark to market movements, right? You bring it back into the original allocation that you intend to hold. Right? When you do that by trimming what has done really well. And from the proceeds, you actually go and buy what hasn't done really well, right? So for example, in an equity bull run, you will see your 65% allocation actually has grown much faster and it has become 68, 69%. Right. So the prudent thing to do essentially is to take this anything above 65%, which was your target allocation, liquidate that, uh, uh, turn it into cash, and then go and buy maybe gold, which has fallen from 10% to say 8%. Right. So that's the systematic rebalancing. It's not it's you don't need any skill to do this. You just need discipline to do this. Anything that has overshot, you bring it back to shape. Use that to fund what has not done well. In a way, if you think this turns into a contrarian, right? What do contrarians do? They take the opposite stance. In a bull run, they will go for something. They will get out of something which is very popular, and then they'll take a position in something which has gone out of flavor, right? Um, by systematic building, you actually turn into a rebalancing. You sell the over outperformed part of your portfolio, which is deviation, at a high, and then you go and buy something which hasn't worked well at the low, and you're essentially selling high, buying low, but not the whole portfolio, only the deviations which are away from your target allocation, right? So it's pretty powerful. It does add alpha, somewhere between 50 bips to 1% based on the portfolios and how it sort of works. But this itself adds alpha over and above the underlying performances of what you want to invest in terms of asset classes, right? Uh, One thing to point out, it's a very simple concept. As I said, there's no rocket science needed. Anybody can do it. Everybody can do it. But everything simple thing is not easy. And the reason this is not easy is because greed, fear, market noises, our emotions, they all come in play. They get in the way, right? In a way, rebalancing will tell you at the peak of the bull run, get out of, sell off your equities and go and buy something which has been out of favor, right? It needs emotional courage to do it when you are seeing this is going up, it will continue to go up. Why should I do it now, right? But when you do it dispassionately, that's when you sort of comes out. So it's a simple concept, it's an easy to understand concept, but it's difficult to execute, and that's where it needs to be done dispassionately. But it's an important one, so I thought I'll just spend a minute to sort of talk about this, right? Now, talking about there are obviously other multi-asset propositions already available, right? The point is essentially to see how Marcellus's multi-asset portfolio map is slightly different from what you would get off the shelf, right? So the first point is asset allocation, right? If you buy a multi-asset a product which is available out there, right? If it's not tailored for you, essentially that means it's one size fits for all. So it assumes the allocation that Manish needs is the same allocation that a Pramod or a Naren would need, right? And as we understood before, every investor, each of us is different. Each of our goals, aspirations, financial situation, time horizons, they're all different. It creates a very unique combination of what I need from a set allocation perspective. But an off-the-shelf, a standard asset allocation won't be able to do that. It will give a simpler allocation to everybody, which is the limitation. What we do at Marcellus, right, before the portfolio, asset allocation is a necessary exercise. So it does take into account all everything that we discussed, your goals, your aspirations, your investments today, your savings that will come tomorrow. All right, how much time do you have for each goal, and all the computation time ready for money, mathematics, whatever that goes behind it, right? But it's personalized to that extent, and it essentially cuts it out. How much do you need for your emergency funds, short-term goals, long-term goals, and how to sort of structure it. So that's the first difference, right? Second is exposure to key asset classes, right? So we talked about global again. You've heard from this before. A lot of off-the-shelf portfolios don't have global export as a part of it. So you do see that equity, which is the most common sort of combination that you see in hybrid or multi-asset products. Gold does feature in some of those, but global equities don't, right? But as we've seen, global equities is pretty punchy. Maybe after Indian equities, that's the second asset class which will drive a lot of returns. And within Marcellus multi-asset, as we invest into global mutual funds as well, we do cover that element. So all key asset classes are sort of covered within Marcellus map. Third thing is response to market events. So you have one size fits all. Again, how the market events, everybody gets the same thing. But again, as I discussed, a market event may impact me differently if my goals are near term compared to you differently if your goals are long term. A smaller noise for a short term is meaningful because it will impact the funds I need for the short term. But for somebody in the long term, it doesn't really matter. The noise will essentially fizzle out, play out, and you'll be on course. So again, by customizing, by personalizing the asset allocation piece, the response to market events also becomes much more relevant when it's done at an individual level, which is part of what we offer in the lab. And the fourth is your ability to have a say to your portfolio, right? So again, if your circumstances change, if your income change, if your goals change, goals move around, in a standard off the shelf portfolio, you don't have much say. Portfolio doesn't change based on how the inputs that you give. But as I said, the allocation exercise at the beginning defines the starting point of how the portfolio should look like, and with every review, that can change. So at any point, there's a change in the input from an investor's end. You connect with us, or when we review this annually, you tell us things have shifted. All of those goes into the consideration. There's a framework, the sort of a model behind this. We punch in those details, we get the output, we contextualize those, and any personal change essentially is also aligned, unique to a new scenario, right? Which is not possible in the off-the-shelf product. So those are the key differences. I think to summarize, it's the personalization of the allocation piece. That's the key. That's the key difference. And anything that impacts that personalization is the second key difference, which in a standard one fit for all approach is suboptimal, and within a map, because it's unique to you, tailored to you, becomes much more meaningful. So that's one way to sort of think of how to look at this multi-asset compared to what else you see in the market, right? So the next point is, how does it all come together, right? How do we move forward from here? So I'll just give a quick gist of what we actually do. So far I've explained what we do, but I'll show you now how it happens. So just bear with me. There's some details, but all of this is indicative. But if you come to us, when you come to us for this exercise, this is what you can expect, right? So we start with very specific information about your future goals, your current investments, and risk profile. So future goals, and what are your objectives? Again, putting the object of the destination on the map. What is it that you're trying to solve for, right? Start with emergency funds. How much emergency funds do you need? Again, based on your income. If you are self-employed or you have variability in your income, you might want to keep a longer emergency fund. If you have consistency, you can get away with 6 months and so on. So defining the length of the emergency fund, the quantum, that's the first objective. Then we work on the retirement, your current age, when do you intend to retire, like assume a life expectancy. What do you want from the retirement in terms of income? Is the inflation rate we are assuming, and that tells us, so some information on how to compute for retirement. And then the goals. Goals can be child marriage, as I said, education, house purchase, marriage, travels and experiences, car replacement, any big ticket items, buying a retirement home, buying another home from family, taking care of ancestral houses and so on and so forth. Whatever that means. Again, this is very, very unique, but we capture all of that. The granular the data, the granular the output. So that's how we work with. But we have ability to essentially work with a very detailed information and do the numbers for you. On the other hand, we look at what are your existing investments. So what are you holding right now? not just the size of it, but also the shape of it, right? Where have you invested? What are the asset classes? Are these regular mutual funds? Are these direct mutual funds? Are these, is there a lock-in? Is it a LIC insurance investment product, or is it pure investment and a pure insurance separately? Again, is it locked till retirement? Is it like an EPS, NPS, PPF, and so on? So we look at liquidity, we look at asset class, and we also look at diversification. How diversified your existing investment portfolio is. Are you over-indexed on real estate, which is largely illiquid, right? So it's a heavy transaction cost as well. So all those things come in play, but we seek data on this front so we can advise you better and see how all of these essentially fit into it. We also look at what are you contributing from your existing savings to your investments, right? Because that will add to what you will get when you need it, right? Uh, we look at loans as well if those are to be paid off and so on. But you put these two together, right? Goals and objectives, essentially your destination, and savings and investment, essentially your where you are today. We can compute, how long the journey is, right? And what's the average speed, and which is the line at the bottom. What is the required rate of return you need on your existing investments, net of taxes, to fund all your goals, right? And that tells you that single number is very important. That tells you how much of a risk, because returns are correlated with risk, how much of a risk you need to take to essentially get to those returns. So that's very informative. Again, it's very important for the next exercise, which essentially we look at all the goals, we adjust them for inflation, we bucket them into time horizons, emergency, long, short. We identify the orientation for emergency. How should we think? For short-term goals, how should we think? Long-term retirement, and so on and so forth. Right, and we arrive at what is the overall asset allocation that you need, right? So this table, essentially, if you read it, the first column is the goals, the rows are all the goals. Uh, then we look at the future value, which is the inflation adjusted value of your goals, right? So when the goal manifests, how much do you need to pay off? Then basically the orientation, what is the right asset allocation? For emergency fund, that's a low risk debt, something like an FD or an arbitrage fund. For short term, pretty much the same. For long term, given this example as an aggressive profile, we do an aggressive allocation. For retirement as well, it's long away, so we do an aggressive allocation. We do have some assumptions or expectations on the returns for each of these risk profiles. So a low risk gives you 6.1% net of taxes. And aggressive gives around 12% net of taxes, which comes to around 14 and a half gross of taxes. And again, you do the math. What do you need today? In this particular example, the investor needs 26.3 CR in the future. If basis this allocation, they need 6.86 CR in today's value. So if they have 6.86 CR today, which compounds as per the respective allocation on the table with the fourth column, right? They end up with the value in the column second, which is the goals, and all the goals are taken care of, right? So now you know how much do you need today to fund your goals. You already know how much do you have today to fund your goals. You can simply compute how funded are you, right? So in this case, the first bar that you at bottom at you see, you are 76% funded, which means 24% short. But you have SIPs. If you continue to channel your SIPs diligently into your savings, into your investments, as per the allocation advised, right, you get to 85, which is a progress, right? And then down the line, if you get more money, maybe a variable pay, maybe a bonus, maybe some wealth is unlocked from somewhere else, you again channel it into the allocation, you get to 100, and 100 is a number. When you get to 100, you are funded, you're sorted. All you need to do is stick to the route and don't take any disproportionate risks. Don't get worried by what's happening around noise. Even if you're short, don't worry about the short-term noise, because your short-term goals are protected with a low risk allocation, right? So all the market risk will not play out, right? And that's the idea. Emergency funds are untouched, no, protected from market risk. Short-term protect from market risk. Long-term optimized for return. The short-term noise should not matter really here. And that's the idea. Every bucket is protected. You get a sense of how are you placed on 100%. And then we can work together to see what levers we can change to make it 100% right away. Or, if you're falling short at some point, what do we do? We do this at the outset. We do this every year. We refresh the numbers, the values, the goals, everything that goes in. Produces a new set of numbers, tells us what we need to do next, and that's how we essentially move forward. This is the plan. This is the route that you got to follow, right? And when we do all of this, it's pretty complicated. I appreciate it. So can get overwhelmed with a lot of data in here. But then we are by your side. We remain by your side on your journey through to destination. The way we do this, we review with you your asset allocation and investments regularly, at least once a year. If needed be more, just let us know and we can connect. right? We ensure that your asset allocation adapts to any changes in your plans and circumstances. If anything has changed, the asset allocation has to, if it needs changing, should change. Right? We help you track progress. So the numbers that we saw, 76%, it is 85%. Is it moving forward? Is it remaining where to do? Or is it deviating, in which means needs course correcting? We do that. The last thing, we help you stay to a course, right? We help you avoiding taking any emotionally charged decisions. We tell you calm down. You are sorted for short run. Your short-term goals are protected from the risks that are playing out. Your long-term goals are okay because these are short-term risk will be taken care of, autocorrect in the long run. So we help you not worry, don't get anxious, don't take any decisions which are driven by fear, greed, or noise, and stay the course, enjoy the journey, sleep easy, fill under your head. That's the bottom line, right? So just to summarize everything I've said, this is the last slide. So appreciate the time and attention you've given. Last slide, goal planning helps you with clarity, direction, and structure. Every goal is different, needs to be planned differently with a different, very specific investment orientation, right? Prudent allocation ensure that you maximize chances of certainty of achieving your goals, right? No asset class does well all the time, right? We've seen it enough. A diversified portfolio essentially plugs that issue, reduces risk, but doesn't compromise on returns. Systematic rebalance enhances returns, but it's very difficult to do by yourself. You have to do it dispassionately. If you're able to do it, fantastic. But if not, you have to find a way to get that done. Right? One size fits all won't work. What works for me will not work for you. It needs to be personalized. It needs to be tailored. And at last, all of this needs regular review. You need to remain on top, not every day, not every month, but at least once a year. And we are here for you. So, and again, any changes that is to be aligned with. So this needs to be done properly and then reviewed properly. And yeah, that's the key summary. This slide essentially calls about our MAP PMS proposition. So again, just to summarize the PMS that we talked about, multi-asset portfolio. So investments in direct stocks, direct mutual funds, ETFs. So it's a direct code, not a regular code. It's in Demat form, in your Demat account. There are mutual funds, ETFs, and other securities such as REITs. There's no conflict of interest, no Marcellus' own products as part of any of these portfolios. The fee is very transparent. It's a 50 basis points fixed fee per annum on the assets under management for you. We collect it quarterly, but we compute the AUM on a daily basis. Minimum investments remains 50 lakhs as prescribed by the regulator at a PAN. If you already have an existing investment in Marcellus, this can be smaller because you would already have a 50 lakhs at the PAN level, right? And for now, it's only available to resident Indians because of the logistical issues of paperwork and mutual fund subscriptions for non-residents. It's not digital. There's a lot of paperwork involved, and it's operationally not feasible to do this at the moment. We are working to see how we can open it up for non-residents as well, but for now, it's only available for resident investors, right? Just to call out, the asset allocation exercise at the outset is free. There's no cost to you, no obligation to you. For existing investors, they get continuous support, but for new investors, when you come in, you do your first allocation, there's no cost, there's no fee, and there's no obligation for you to invest with us. So that's our promise and that's our offering. And the next session is you just let us know. Just drop us a yes in the chat box if you can, or we have contact details here as well. Just drop us an email or make us a call, and we'll be happy to do asset allocation for you. We'll understand next step once we have all the information. We'll understand your allocation based on your goals and tolerances. We come and present to you. You may consider Marcellus as multi-asset portfolio as a solution to the allocation that we showed. And if you do invest with us, periodic reviews, constant counseling, investment counseling, anything that you need from us, we will be just a phone call away. So that's the next step, and that's from me. Yeah. Thank you. I'll take a pause and back to Pramod.
Thank you. Thanks, Manish. That was fairly interesting. So folks, if you have any questions, feel free to drop it in the Q&A box. I'll take as many as we can. And like Manish said, if you are interested in the free asset allocation service, just drop in a yes in the chat window and we'll reach out to you. We do have a few questions already. One of the questions I think you've already addressed, people saying that there are multi-asset mutual funds available. Why bother with this? I think I think there is no one answer to this. And as Manish has already highlighted, literally he's given out the entire asset allocation strategy, transparency. So the asset allocation exercise by itself is no rocket science. I'm sure there's plenty of material on the internet. If you'd like to do it yourself, you can definitely do it. But I would still recommend using an advisor, because the last bullet on this slide is perhaps the most important. It's not so much a technical skill that differentiates here. It's more about a behavioral counseling where you seek from advisors. There are plenty of good advisors out there. We work with plenty of them in the past. Over the years, when we didn't have this service ourselves, we've referred many of you bad year. I don't think the science itself is, I'm not trying to undermine what Manish has built here, but the clear value add is more on the counseling side. So that's what I would say. If you think you can manage the greed and fear emotions, you can do it yourself and construct this yourself, as Manish has given most of it out. There's no secret in the what of it. It's really the journey where you need somebody to um, all of us need somebody to stop us from doing stupid things time and again. That's my take on it. Manish, you want to add anything on that?
Yeah, no, I think that's the most important. So I did explain on a slide how this is different, right? So multi-head portfolio is one, right? Aligning that portfolio to you specific to you, which is the asset allocation bit, is a totally different, and they both are mutually exclusive, right? While there are off the shelf, mutual funds, for example, but they will have a standard allocation, a standard approach. How much of it you should invest in, how should you think of it? The whole understanding quantification piece. That's the asset allocation piece, which probably the funds don't do, or maybe advisors might do. So that's one thing, but you don't need probably will need some help onto that. But that's part of the answer. I think once you get in, every day we are surrounded with the noise, and that's the counseling bit. As Pramod already did, I also completely agree. That's the most important thing, because we are surrounded by noise even more so wherever we go. There is something or the other that we hear, where you have to think, should we act on it or not? And sometimes it's meaningful enough for us to think whether we should act or not. But if you've done the asset allocation, if you have safeguarded your emergencies, safeguarded your short term, optimized your long term, if you are doing rebalancing as you should, if you are reviewing it every annually as you are, if you're changing the allocations as needed, right? If you're doing all of that, then it's not needed. I mean, it's not rocket. None of this is rocket science. Even the computation of the goals, it's all time value for money. Simple formulas available everywhere. None of this is that, but it's essentially bringing all of this together along with the hand holding that's needed. And most of the time we can't do it. I mean, simply speaking, again, that strategic rebalancing, as simple as it sounds, it's very difficult to do, right? Because you have to override your emotions, greed in that time, right? That this is on a bull run, this is on a run. I don't know how it will run or not. Should I do it or not? And same on the other side, right? The fear takes over. So controlling your emotions is the larger key. If somebody can help you with that in a more structured, informed way, and again, which you understand and align with, that's the key problem to solve, right? And what you buy into it is a separate is something that adds to it. But the core is essentially the allocation and the counseling.
Yeah. So there's a question about, I already have a PMS with you. Do I have to invest another 50 lakhs for this multi-asset PMS?
So the answer is no. From a regulatory perspective, you are an investor. If you open the account, or if you wish to invest in the same name, same PAN number to be specific, from a regulatory perspective, you would have already enough to open another account with us. You don't. However, when you do asset allocation, obviously, how does your existing investment fit into the whole asset allocation is something we will assess for you anyway. So yeah, nothing stops you. You don't have to invest all of 50 lakhs into this into MAP to start with. When we do the asset allocation for you, we can guide you more onto that. But no, you don't need all of 50 lakhs. You already have qualified.
Yeah, so just to reiterate, the regulatory requirement of 50 lakhs from SEBI is at the PAN level. So if you have already invested in one of our products, say CCP, with 50 lakhs, you've already fulfilled that criteria. You can incrementally invest as little as 10 lakhs with us. But having said that, the whole exercise here on a multi-asset side is worthwhile only if you apply it on your entire portfolio, right? This can't be used for, I mean, I can understand this is new, you would want to try it out, you can start small, but eventually you would want to apply these principles on your entire portfolio.
Yeah. So just to add on to this, right? So you can do a smaller allocation to this, but as I said, the key kicker here is the strategic rebalance, is the systematic rebalancing, right? Which you need to do. So if you have certain other investments which are sitting outside, within the Marcellus multi-asset portfolio, we can't touch them, right? So we can't rebalance if that part of your allocation has shot up, right? So, but obviously we can do what we can do. So you can start small, but when you think of asset allocation, you should think of it as an overall level, not just a specific investment with any specific manager, right? So that's how you should look at the whole allocation when you invest with us. Even a part of your investments, the asset allocation that we do, we will do it at holistic level, right? Just that we won't be able to act on it because we have no control on how it's to be done. So we'll do the whole allocation, but we'll manage only what you give us. But it makes for the 100%, but to make fuller sense, the full portfolio is managed like in line with the asset allocation. That's where the real benefit sort of comes out.
A similar question on similar lines is, what is the time horizon, how many years for which we need to invest in? Now, just to add to it, we've always advised investors to invest in our equity products with a minimum 3 to 5 year horizon. Is there any such minimum here?
Yeah. So ideally, this is your core portfolio. So again, it should be long-term oriented. The way it's slightly different from equities only portfolios is because it's multi-asset and because we are doing an asset allocation, that anything that you need for the short term. So again, this has to be guided by what you need the money for, when you need it for, right? So if it's a short-term need, as I said, it needs to be oriented. It needs to be looked at differently. It needs to be invested differently. It needs to be protected more from the risk than for optimizing the returns, right? So we do that in asset allocation. If we see that's the case for you, we will identify, quantify, and that part of it goes into the short-term sort of a bucket, and it's managed differently than your long-term investments. So if you do asset allocation approach, you can essentially manage, or we can manage for you the whole soul, it's your short-term and your long-term as well. Right, emergency funds we can do, but we advise emergency funds to do it with your bank because that's the easiest way to access money. Right, and the second choice we say is arbitrage funds maybe. So we won't manage your emergency funds. We don't want to manage your emergency funds. But the short and long term both can be managed by us within this construct. If you want to manage short term at your end, again, we'll quantify that for you. Long term obviously has to be at least 5 years out. That's how I'll say. When you were looking for your long term goals, that's the minimum you should look at. However, it won't be as volatile in the short run as well either. But it's an equity oriented portfolio. Any swings in equity, substantial swings will have an impact. So anything 3 to 5 years, 5+ years is the right way to think of long-term goals, investing for long-term goals.
Great. Another question you preempted is, can NRIs invest? Unfortunately, not as of now. Hopefully, we'll figure out a solution for you sometime in near future, which should also enhance the experience. Right now, it's a little bit clunky, but we'll stay in touch with you should we figure out a solution on that.
Please do drop us an inquiry with calling out that you are an NRI. We'll add you to the list, and as soon as we have something, we're actively looking to solve with the pace the whole tech is happening in this space. We hope that's not that far. So please do drop us a line and just call that you are an NRI, and we'll get back to you as soon as we have something to do for you.
Sorry, folks. For some reason, the chat window is disabled. You can instead express your interest to invest in the Q&A box itself by saying yes. We'll take note of that and reach out to you. Okay, there's a question on, can we do asset rebalancing multiple times in a year, and can we provide our inputs for the rebalancing?
Yeah. So So multiple times in a year. So again, the trade-off with rebalancing is there's a cost involved. Cost involved in terms of short-term gains if you do it very frequently. Any tax gains if you at any point you do, assuming there's a gain. Right. So that's the tax incidence happens. Again, there's a small transactional cost of doing change as well. So we only do rebalancing when we do it, when the benefit outweighs. Right. If everything is growing in unison, there's no need to rebalance because allocation is not changing. Right. But when we see the benefit, the dislocation, something has outgrown, only then that is when we do the rebalancing. So uh, not very frequent is not really advisable unless there's an extreme market event which has created a gap in terms of something has done really good or really bad. Right, so that's the first that's the answer to part one. In terms of your say in rebalancing, I'm assuming you're saying in the say change my equity to more or gold to less. That's something we can't accommodate at the moment. The reason being it's a common portfolio, right? Which is so there are three variants, but when you pick a variant, you get that variant, and the portfolio manager who manages this essentially manages that cohort as a whole, right? And again, that's to do with uh, the holdings in that portfolio, however they have moved on, they are brought together. So the portfolio that you get in the three variants remains constant. So it's not possible to do a bespoke rebalancing for any specific investor for their holdings. The rebalancing happens for the whole portfolio as a whole, and you will get the same portfolio as anybody else, who has selected that variant in map. So that's the answer to the second question.
Yeah, in my sense, that defeats the whole purpose as well. Remember, the whole idea is to sort of manage this in a dispassionate manner, which is why it's systematic rebalancing. If we start giving our inputs, you never know when we are being driven by the emotions that Manish has highlighted. Uh, as it is customized. I think between these three variants, most combinations of return and risk expectations are catered for. If there are any specific unique goals, we can construct something separate. But as far as the multi-asset is concerned, better to be managed at our discretion. You'd have the choice of choosing which variant anyway, which should be an outcome of the whole financial planning and risk assessment, rather than your choice. But beyond that, happy to help you if you can drop a line on that. Uh, there are questions on the reporting piece, Manish. How do they get to see their portfolios? How frequently do we report it? Is there a portal that they
Yeah.
can see the portfolio real time and so on?
Yeah. So it's pretty similar to our other, equity PMSs as well. So it's the same platform that we run the accounting for, same portfolio, same portal that. So I wasn't sure if you're an existing investor, but yeah. So you will get to see your portfolio pretty much on every day. The valuation gets updated overnight as we receive the feeds for MFI and for the security when we receive the BHAV copy from the exchanges. That's applied towards the end of the day, and the next day you will be able to see the updated value of your portfolio. You will be able to see all your holdings, including names and sectorial representations, and sorry, sectorial as in the asset class as the categorization as well. Only thing is global funds report their NAV pretty much midday on the next working day, right? So that they will come with a bit of a lag. But in terms of holdings, you will get to see what you're holding, and you get so that's something when you log in, what you can see. What you get from us is a month end of the month statement, end of the last working day of the month. You get an evaluation report uh, that we send to you every month. On top of it, you get a once a quarter report, which is in the regulatory format. So regulator has prescribed a specific format. That report comes once a quarter to you. Apart from that, if you at any point you need a printed or a PDF report in your email, just drop us a line and we can send you the report as well. But the access to you is pretty open, available, transparent, the way it's been always for all of our investors. You log into the portal, you get an OTP, you punch in the OTP, and you can see your portfolio.
Got it. There's a question on why use arbitrage funds instead of debt mutual funds.
Yeah, so arbitrage funds pretty much behave like a debt mutual fund, but they are favorable in terms of taxation. So they're taxed like equity, but they behave like debt. Right, and that's primarily the difference between, and maybe that's the arbitrage today. Maybe that will go away, but for now we have that sort of taxation arbitrage. So that's the idea. If you want a debt-like behavior and an equity-like taxation, which is beneficial, that's where the choice of arbitrage funds sort of comes in. So an element of debt and income goes into arbitrage funds.
Yeah, another question is real estate, as we know, is a huge asset class in most Indian households. Why haven't we featured that in these portfolios?
Yeah. So real estate is a popular asset class. All of us would have it in some shape or form. Most of us would have it in shape or form, or would want to have one. So there are a few ways to look at it. One is, when I call out, I called out as well. The house that we live in, right, it's more of a need, not an investment. So we shouldn't think of it as an investment. An investment is something that you are happy to sell, liquidate, exchange for another investment if need be. It's the house that we do even when we do asset allocation for existing investors and prospects. Once they come in, the house that they're living in, we check with them, and it goes into the estate. It's not part of the investment, right? If there's any other real estate investment made, then that becomes part of the investment pool. Now there are uh, it's a popular asset to hold, but there are considerations to be made having to that. Number one, as a ticket size, it becomes pretty heavy, so it's very difficult to buy a small chunk of real estate. The commitment is substantial. If you make a substantial commitment within a specific side of balance sheet, you may end up with a disproportionate bigger allocation to real estate itself. And so that's one big reason. Putting real estate as one of the asset class, it just doesn't sort of fit. It's like an MRF stock in a 1 lakh portfolio. That takes the lion's share. The second reason is real estate can be inflexible. You can't sell a part of it like you can sell a part of your mutual fund holding to realize the cash when you need. Third thing, it's not as liquid, it's heavily cyclical. So it goes through its cycles. It's similar to the equity, but maybe worse than equity. It's just a long cycle when the value really comes in. Fourth is every house, every property, every plot that you buy is a micro market in itself, right? It's not a really readily market like other marketed securities. So the price that you get for it, or the valuation, the expected returns that you expect from it, can be a bit of a challenge. In some cases, it does generate yields, but the capital growth underneath capital growth is very difficult to assume what you're going to get, right? So that, and a core asset class has to sort of tick all these boxes. It has to be fungible, flexible, widely traded, deeply traded in the market. Should be easy to value. So having real estate as a core investment into this multi-asset portfolio doesn't fit into because of these reasons, and largely because of the size of the commitment that's required. However, uh, if you have more, if the size of your overall portfolio is more than your goals, which will happen in time, and you already have a house, right? Anything beyond that can be part of the real estate. Nothing wrong with that. It again, the expected returns and all is a question. The underlying capital growth, will it sustain the growth, or will it's going to be lumpy? And the transaction cost, you trade it, there's an 8 to 10% transaction cost when you trade in the security. So those are the reasons it's not the right fit into the core portfolio. But over and above, once you have guarded all your future goals, if something that you want to invest in, it can be considered for that, but not for the core portfolio to begin with. And again, I'll say the house that you live in is not an investment, so that's something that's already out of the scope of this exercise, unless you want us to put. So that's the way to think. Pramod, you can add to this if there's more on this. You're on mute, Pramod.
Sorry. I mean, I agree to the extent that it's a financial asset, unless it is something like a real estate investment trust, which we do have for commercial real estate in the country. We can replicate the effect of real estate in the portfolio. At the end of the day, real estate. Well, let's step back. The whole idea of diversification is to have asset classes which have very low correlation with each other, right? That's when the real benefit of diversification is. This flows from the modern portfolio theory, for which Harry Markowitz won the Nobel Prize several years ago. In fact, Whilst most economists say there is no such thing as free lunch, he was the one who is famously said to have said diversification is the only free lunch. To the extent that real estate might have low correlation with some of the other asset classes in your portfolio, there is a value in having real estate in your portfolio. But the distinction we're making is the physical real estate, which is very hard for us to manage. But when we're making the financial plan and the asset allocation, we do take into account what investments you do have in real estate, what implications that has in terms of correlation with the other asset classes that we build for within multi-asset. But for us to manage that, it becomes hard in this structure. But as Manish showed, we do have exposure to commercial real estate through the real estate investment trust. There is talk or plans from SEBI to have residential real estate investment trusts as well. Whenever that comes into play, we can give exposure. And remember, the core philosophy here is to add more assets which have lower correlation with the rest of your portfolio. That's the real benefit of diversification we want to help achieve for yourself. There's one question, Manish, is there a dividend option in your multi-asset portfolio where somebody who wants income on a monthly or a quarterly basis?
Yeah, so from an income, we don't have the dividend option per se, but we do have a solution for the income drawdown, right? So we have an income portfolio, which essentially invests into securities which are primed or oriented towards income and equity, right? And when we talk about asset allocation, again, it covers end to end, right? So from contribution to building to growing, and then when it comes to drawdown, we can have a portfolio which is managing the long-term goals on a certain allocation. And as your income needs come closer, say next 3 years, short term, when we call out in the retirement phase, right? We do a transfer of some of these. Again, we do the computation, but we transfer the required corpus into an income fund, right? And we can set up an SWP from that income fund into your bank account. So that's the organic way of drawing down, kind of an annuity, if I may sort of position it like that. But so that's the way that's the way we are thinking of, and we have an income solution. But when you talk about a dividend payment as such, given that dividend is going to be minuscule, and at the same time, there are some we also have some income products into this. So the idea essentially we are using those to minimize the deviation for the rebalancing. As we speak, direct answer to your question, there's no dividend drawing option, but we have a larger, more structured solution towards on a systematic withdrawal plan, which is probably all of us will need when we get into the retirement phase or the consumption phase.
So feel free to reach out to us, sir. We should be able to construct a solution for you. And yes, there is no lock-in, right, in any of these portfolios?
No lock-in, no entry, no entry load, exit load, obviously, no lock-in.
Got it. Okay. I think that's pretty much all the questions that I had. This has been very useful. Thanks, Manish. Appreciate it. Thank you so much for joining us. Like I said, if you have any questions, feel free to reach out to us. Manish, you might want to flash the contact details one last time before we bring the call to an end. Thanks, folks, and have a good Friday and have a good long weekend.
Thank you, everyone, for joining us. Have a good evening.